Hello everyone, welcome to Betty Academy. Our job is to make school easier. Kindly subscribe, watch, like, share, comment, and don't forget to hit the notification bell. So in this lesson, we are going to learn about the capital structure theory. And with the capital structure theory, this one falls under Modigliani and Miller, otherwise referred to as approach. And we have the assumptions. The assumptions are 1. Tax rate is 0%. Transaction cost 0. 3. Same information. So we have the investors and corporates. They have access to same information. 4. The flotation cost is 0. 5. The corporate dividend tax rate is 0%. So we have the prepositions that fall, those ones that the prepositions that they came up with. So we have the M and prepositions without taxes. That is preposition 1 and preposition 2, and that one we had covered in our previous video. So if you've not watched our previous video on capital structure theory, Modigliani and Miller approach, but with prepositions without taxes. So in this lesson, we are going to learn about the preposition with taxes. And in this case, we have this approach with corporate taxes does acknowledge tax savings. Yeah, it does acknowledge tax savings. Yeah, so the Modigliani and Miller approach, it assumes that there are no taxes. But in the real world, this is far from the truth, because most countries, if not all, tax companies, right? So this theory recognizes the tax benefits accrued by interest payments, right? Because you realize that the moment we have the moment companies are taxed, we have there are those tax benefits that are accrued from the interest payments, because the interest payment generally they are not they are not subjected to tax. So in that case, they get some tax benefits. So the interest paid on borrowed funds, yeah, of course, if you borrow funds, you are entitled, you are supposed to be paying interest. So the interest paid on borrowed funds is tax deductible. However, the same is not the case with the dividends paid on equity. In other words, the actual cost of debt is less than the nominal cost of debt due to tax benefits. Yeah, I hope you are together up to that point. Yeah, so the moment you have, for any capital structure, yeah, that you have, in terms of the source of financing, we have the debt component and the equity component. So for the debt, this one you have to borrow funds, this one you borrow funds, and the moment you'll be repaying that particular loan together with the interest that you are paying, it is tax deductible. But that one does not apply on dividends, because dividends paid on equity, it does not, it's not tax deductible. So we have the trade-off theory advocates that a company can capitalize its requirements with the debts as long as the cost of distress, that is the cost of bankruptcy, exceeds the value of the tax benefits, right? Yeah, so the trade-off theory, it advocates that a company can capitalize its requirements with the debts, because the moment it has debts, it means it will be benefiting from the tax savings. But that one, you can only do that as long as the cost of distress, that is the cost of bankruptcy, you don't overborrow to an extent that it is exceeding the value of the tax benefits, because that one will be it will not be cost effective to the company. So thus, the increased debts until a given threshold value will add value to a company. It will add value to a company. So this approach with corporate taxes, it does acknowledge tax savings, yeah, because practically most companies, they are taxed. Yeah, so this approach with corporate taxes does acknowledge tax savings, and thus infers that a change in the debt equity ratio has an effect on the weighted average cost of capital. This means that the higher the debt, the lower This means that the higher the debt, the lower the WACC, otherwise referred to as the weighted average cost of capital, because the tax savings reduces the cost of debt, and eventually, being that it is a weighted average between the debt and the equity, it lowers the weighted average cost of capital. The Modigliani and Miller approach are one of the modern approaches of capital structure theory. So that is the preposition with the taxes. So one, for it to hold, it assumes existence of taxes and tax benefits due to the interest payments are recognized. Yeah. Then two, so cost of debt reduces by interest tax shields. Three, therefore, change in debt component can affect the value of a firm, right? Yeah. So that's the end of our lesson. Kindly don't forget to subscribe and hit on the notification bell. So kindly watch out for our next video. Until next time, goodbye.